Welcome everyone to this month's installment of the Intentional Success webinar. Today, we're going to talk about one of my favorite things in the world, which of course is numbers, business metrics for the hybrid event world. So a lot has changed over the past couple of years in terms of how we're operating our businesses and the types of projects that we're doing. It's about time we updated some of our numbers, and we're going to talk about that today. If you are new, welcome. I am Tom Stimson. I am president of the Stimson Group. I work with the owners and management teams of live event production companies or anybody serving the live event marketplace. I've been doing this for since 2006. I've been in the AV industry for over 40 years. So this is my space. This is what I know to talk about. And I very much appreciate all of you being here today. This session is being recorded, as you just heard. I usually have the recording posted within an hour after the event is over, depending on whether I've had lunch or not. So you'll be able to get that very quickly, and you'll receive an email to remind you of how to access the replay page if you haven't bookmarked it already. Post questions in the Q&A box, please. I won't be able to follow the chat, especially when you guys are having a lot to talk about. But if you're excited or disagree with something, boy, let me know about it. I always welcome the feedback. If we haven't talked before, even if we have talked before, if it's the time to start working on your business and get past the noise of the past couple of years and work on that moving forward thing that you've been waiting to do, well, let's have a conversation about that. It's free. I'll help you any way that I can. If there's a way that we can work together moving forward, we can talk about that, but don't hesitate to reach out and let's understand what's keeping you from moving along. And that's what I'm here for. I'm bringing back the pandemic update for this month, hopefully only because of Omicron. And we have a variant that's in play that everybody here knows about because it's been affecting our lives for well over the past month. Wrecked a lot of holiday plans, a lot of Christmases and New Year's Eve plans, and certainly more than a few shows have been affected over the past several weeks and for several weeks going forward. So I will say that this is not a surprise. All right, we knew that this would happen. We knew that these things could happen. Omicron is highly transmissible, very different from the Delta that we've been dealing with. But Omicron is going to burn out from what the epidemiologists say. We're already seeing signs of it in countries who got it first, that it is slowly burning through society, and hopefully, and it's not as deadly if you've been vaccinated. There are fewer hospitalizations, things like that. You know all of this stuff. You watch the news or read, but it's going to go away, and we'll be back to Delta, which we already know how to do. And here in the U.S., certainly that last fall, we had a very successful reopening under Delta protocols. We know how to do that. We'll get to do it again here very, very soon. Now, I will say from in my crystal ball, this virus mitigation is not going away. We are looking at an endemic situation where we feel that COVID may never really go away, and we're going to have challenges working with it, but we're going to get better and better at it and more used to it. And there will be variants like Omicron that will pop up, hopefully temporarily for a short term and then go away. And our vaccines will hold up, or maybe the newer vaccines, because it's very easy for them to change vaccines. My point is business as usual. This is our new normal business. We need to work that way. We need to have protocols for dealing with this when it pops up. We know how to shift. We know how to write proposals. We know how to regroup. We know how to do all of the things that allow us to continue to work with these little setbacks, these little ups and downs. There's going to be other Omicrons. And remember that uncertainty creates insecurity. So the best thing you can do is be certain about how you respond in any given situation. When this comes back up again and clients need to cancel things, you need to know exactly how to talk about it. You need to have prepared for that in your proposals, in your terms and conditions to begin with. And you need to have a tried and true method for migrating them into something as a replacement or an alternative or a postponement that is going to work. Some other permanent changes I want to remind you about that are really these aren't a result, these aren't punishment for the pandemic. These are actually pretty good things. So I just want to remind you that you've got some permanent changes to your business as a result of everything we've learned over the past 23 months. Thank you very much. One is that you should be earning significantly higher profits. And so you need to start targeting that. And I will talk more about that later on in this webinar. Keeping overhead down, I'm going to keep preaching it. I'm going to keep preaching it. If Omicron is proof that you need to keep your overhead down, right? Because you never know when you're going to have a setback and have cancellations that are out of your control. Keeping your overhead down reduces your exposure. Running that agency model in your business where you outsource as much direct work as you can will help keep things going. But you also are going to have to pay more for those services, and you're going to have to pay more for your core team. So you need significantly higher profits to reduce your risk or absorb some of your risk and all of that. Pricing. Pricing based on outside costs at higher margins. So pay close attention to what's going on in the marketplace. If you have a supply chain constraint that's forcing prices up, then you've got to raise your prices so that you can maintain your margins. But this is good. This is an opportunity for you to better educate your audience and your customers about how to budget for things. So set a budget, spend what you can, but what you're able to buy with that budget is going to fluctuate in ways that we've never seen in our careers before. Eliminate the concept of deposits. Get people to pay you for the things that you are doing, not a fee that you might have to refund to them later on down the road. Big, very painful lesson that we've all learned in the past 23 months. So keep that on track and keep getting better at applying fees and building fee-based payments for services rendered that are not refundable, where there are tangible assets, outcomes for the customer along the way. And then in all of that, sell from a position of strength. We're in a supply-demand curve where our supply cannot meet all of the demand, and we're actually in a really good position as sellers to sell from a much stronger position. So selling from strength means that you can be firmer on your price, you can be more diligent about your terms and conditions, and there is more work waiting for you. If you don't get this job or this client, there's 3 more in the wings that are ready to go that you haven't had time to get to. So enjoy that for as long as it lasts. Use it very, very well. As many of you are, and my clients, lots of very, very proud of the success that they've had, especially over the past 18 months in figuring out how to manage their pivot, take advantage of these opportunities, become better at pricing, better at negotiating, better at keeping their scope from creeping, so that they could do more business, earn more money, keep their customers happy, deal with a new clientele, wonderful new buyers that they're dealing with. So there's so much good upside to what's going on. I just want to remind us every once in a while, especially when we're having a few bad weeks of cancellations and postponements that make us nervous and make us feel like it's 2020 again. This is temporary, and we continue to be in a very good position to be profitable and successful going forward. Speaking of which, good segue into the numbers. Let's talk about some business metrics. And those of you who follow me know that this is one of my favorite topics, one of the things I love to talk about. Why this webinar? Why now? Look, your old key performance indicators probably don't really matter right now. The things that I was teaching you 3, 4, 5, 10 years ago aren't relevant today. So we need to look at our numbers differently. And I'm going to give you a fairly simple, straightforward way of doing that that's going to help you out. Measurements should be not just relevant, also actionable. Too often I find people measuring things and tracking numbers that, if I ask them, if this number changes, how are you going to, what's going to be different? Or what are you going to do differently? And they don't have an answer. It's a shrug. Also, that's not actionable. let's track things that if something changes, we know what to do about it. Either we're going to reinforce it because it's a good thing, or we're going to mitigate it because it's a bad thing. And then our current economics, the supply demand, being on the sell side of a constraint is great, but it does affect the fundamental business decisions you make a little bit. So that's why we're going to talk about these things today. Thanks everybody who's just logged on. Hey, say hello in the chat. Don't forget to post questions in the Q&A. Post them at any time. I will try and answer them in the middle of the presentation if they seem to fit right in. Otherwise, I will get to them as we get to the end. So I'm going to talk about 6 different areas here. Job cost. We're going to talk about risk. We're going to talk about how your P&L should look now. And if you haven't changed your P&L, you're going to want to after you hear from me. We're going to talk about that balance sheet thing that no one ever seems to ever look at. And there's also a statement of cash flows in your financial package that you've never looked at either. And I'm going to give you some reasons to pay attention to those things, especially now. And also want to touch on how all of this affects your exit strategy and how you set up your company to look valuable for eventually selling it or converting it in some way to support your retirement or the next thing that you want to do. So at the end of the day, owners or investors, we need to pay attention to exit strategy, whether or not we are exiting today, tomorrow, or next year, or we don't have plans, but we need to do the things that give us a better exit position because it's just good business, right? All right. I'm going to start off with job cost because, well, that's where everybody seems to live. That's what everybody's looking at. They go, oh my goodness, look at the margins we're getting on these jobs right now. And then we say, we don't want to do that job because the margins aren't as good as these other jobs. But in fact, you need all sorts of different margins in jobs. And the fundamental problem is that we look at job cost incorrectly, and we have for years. And this is one of the boulders I've been pushing up a hill for a long time. Big messages here. 1, job cost and cost of goods sold are not the same thing. Your job, the income and expense of your job is not a profit and loss statement. Okay. Job costing doesn't work that way. Cost of goods sold and a profit and loss statement are financial measurements. Job cost is management. It's managerial accounting. It tells us how profit is generated and where cash is going to come from. But it's not necessarily a good assessment of whether or not this particular project was a good idea. We have to look at all of those projects together and pull back in the macro and look at all of them. So we often use job cost incorrectly, but we're going to work on getting better at it, right? In your job cost program, however you're looking at job costs, be sure that you are charging that job for all inside labor and equipment. There is nothing free in job cost. The fact that you don't have to hire someone from outside, or you have the equipment on the shelf, or you own all of the studio, does not change job cost. Okay, that's a cost of goods sold thing. We still need to charge the job for using those things. And what we use is replacement cost. So if every job is paying for replacement cost, and you happen to have some of those replacements in-house where they might be less expensive, that's not really the job's advantage. You may look at it that way, say, oh, well, this job is more profitable because we got to use in-house resources. In fact, it is the company's advantage for taking the risk of having those resources. So we still want to cost the job based on what it would cost to deliver if we didn't have the internal resources, but we want to judge the management of the company based on, did we use those internal resources well, right? Therefore, if you're charging jobs for everything that they are using, whether it's inside or outside, then all revenue would have a very predictable job cost. And you should, if you are good at estimating and pricing things, know what the job is going to worth. Your beginning job cost and your ending job cost should be about the same. That's not the same as the cash generated from the job, because if you have internal resources that you can use, the job will generate more cash because we didn't have to spend cash on anything. But the profitability of the job is still based on replacement costs. What does it cost me to deliver this job, whether I have the resource on hand or not? All that extra profit you get by, oh, we weren't busy that week or so-and-so was available, is a scaling profit, and that belongs to the organization, not to the job. So knowing this, we have two major behaviors on job costs that we want to pay attention to. When your revenue is low, your actual cost of goods sold on your P&L will be less than what the job cost is. So you'll add up all the jobs and the job costs, and it looks like, well, you made your 38% average gross profit on jobs based on your estimating, but on your P&L, it looks like you made 70% because you used a lot of internal resources. When your revenue is high, your actual cost of goods sold is going to mirror the job cost estimate, because the job's never going to have to pay more, or should on the average not pay more than replacement cost, which means we're going to have very predictable outcomes. The beauty of this is it makes your company very scalable, because if you add another 25% of revenue next year and you don't fundamentally change your overhead, which you shouldn't have to for a 25% growth, that's a lot of extra profit that those jobs can generate. So when revenue is high, you're still going to make money, though the individual jobs will only make the minimum expected gross profit. This is all important because of risk. Prior to the pandemic, in the before times, this has always been a risky business to be in, but the returns on the risk were extremely poor. Companies risking, basically the entire value of the company on a single job, when at the end of the year, they're going to make 3% net profit. It's just insane. It's just crazy. Why would you even want to do that? No other industry does this. Nobody wants to invest in an industry where you take on that much risk of doing a major event, not just the safety issues, which are huge, just the fact that one little mistake could bring the entire show down, the client doesn't want to pay you. That's a huge amount of risk, and you can't mitigate that cost that goes along with it. People are still going to have to get paid. And you do all of that for marginal net profit. It's not a great idea. So we have to remember that the gross profit that we're generating from our jobs, sometimes it seems like a really huge number, except that it has to pay for all of your overhead plus the profit that you need to make. It still has a lot of work to do before it gets to that gross profit line. And net profit has to pay for debt service, and it has to pay for taxes, and it has to fund retirement. It has to pay for depreciation, right? There's a whole lot of things that gross profit has to support. Therefore, profit is non-negotiable. Corporate profit, the net profit from your company must be much higher than what you're used to. And now is the time to do it, when you're in a position of strength. You're running less overhead. You're not being forced to take on empty calorie revenue just to get some cash moving through your business so that you can cover your huge overhead. Now you've got a lower overhead, so you can be more selective about the stuff. And the jobs you're taking are higher margin, right? So you don't need as many of them, but you'll take as many as you can reasonably handle. So let's start thinking in terms of what net profit should be. They need to rise. This is the year, guys. Target 20% net profit at the end of the year for all the work that you've done. That's a reasonable return for the type of risk and the type of business that you're in to do. Next year, I'm going to tell you, shoot for 25%. But no more of this single digit profit stuff, because we don't have to, right? We are not the victim anymore. We're not the fly anymore. We're now the windshield. So change your thinking about how valuable you are and what you're willing to live with in terms of profit. P&L statements, profit and loss statements. I know sometimes I talk about these things and I assume that you at least took a financial accounting course in college or something like that. But for most of us, I know your entire introduction to finance is through QuickBooks. And if you don't understand it, you barely even look at those reports. You just wait for your accountant to tell you how big of a check to write to the tax agency at the end of the year. Okay. However, profit and loss is very simple when you break it down into the actual components. To make your old profit and loss statement, and I've seen thousands of them. I know you've got some rental income, and you've got some labor income, and you have some expense income, and maybe a few other things. You might have had 6 or 7 income categories, including a miscellaneous, which why would you ever have miscellaneous income? But we still managed to do it. But you need new income accounts. So in this world where we're delivering a lot of services, I'm strongly recommending that you add a bunch of service items on your income accounts for studio rentals, for content creation, for platform usage, things that weren't there. Don't roll them into other stuff. We need to break these things out. The reason is they have a corresponding cost that goes with them, which is actionable. So if we can match our cost, okay, to the income, we can say, hey, did we price this correctly? Are we buying smartly? So your cost of goods sold, you're going to mirror your income lines. If you've got 12 income accounts, there better be 12 plus cost of goods sold accounts, because I want to mirror those income accounts and capture all the matching expenses that go with those particular incomes. Plus, you're going to have additional cost of goods sold accounts for things that are shared across all jobs that you can't necessarily break out. And then I'm going to monitor the ratios, right? I got to look at this stuff. I look at the price to the cost ratios. I need to adjust my costs sometimes. I need to adjust my margins sometimes. I need to do a better job of buying. Maybe we need to buy that equipment. Maybe it is time to hire another person. And while I say don't hire more people, sometimes you're going to hire more people. These numbers are going to tell us when, right? That'll get us to our gross profit line, right? And we're all pretty familiar with this. I just want you to categorize it much more intentionally so that you can see how these things connect and quickly see what's going on in your business. Now, in overhead, which in theory never changes. I mean, it's pretty dull, it's boring. But looking at a trailing 12 months, which means we're always looking at a year, we can start looking at our overhead ratios relative to our income or revenue to see how much we're spending to do that. And I break overhead down into 3 areas: the cost of sales, which is salespeople, commissions, marketing, sales support. Some cases, half of your project management team is in cost of sales because they're only involved in selling the job. They're not just delivering the job. All of that goes into one bucket. And before the pandemic, you might have been spending somewhere between 8 and 12% of revenue on sales. In your new model, if you're doing more agency and more service work and less rental plus labor, then your cost of sales will go up dramatically. It may be as much as 20 or 25%, because one sales unit can generate so much potential income at much higher profit margins. So we're seeing a change in how much the percentage that should be. Admin's admin, financing is, interest expense and things like that. It's generally not a lot of stuff going on there. And that's going to get us to a net profit from operations, or operating net profit, which is how I measure how well my management team is doing. Is management getting us the operating profit that we need, which is technically the net profit from operations. However, there are some non-operating income and expense things that belong below this line, so we want to get below the line of net profit from operations and make these adjustments. For instance, I have sometimes owners don't pay themselves because they're trying to preserve cash. However, I would still charge for them in the cost of admin, and then I would create an add back in non-operating income and expenses that gets us back to the true net profit of the organization. And the adjusted net profit, that true net profit, is actually what the owner is going to pay taxes on. So all those things that are adjustments, your PPP loans from 2020 and 2021, if you're in the US, those, if were forgiven, therefore they converted to income, but they aren't income up here at the top because you didn't do anything. They're income, non-operating income down here at the bottom. So if you had zero net profit from operations, then you add back in your PPP loans, your adjusted net profit, which has nothing to do with operations, actually increased. So a little bit different way of looking at things, but much cleaner, much easier to identify who the stakeholders are at each step along the way. So I got sales accounting for income. I've got operations accounting for cost of goods sold. I have management mitigating overhead and delivering us a net profit from operations. And now I can look and say, hey, if something's not working, I know exactly where to go to make that fix or make that adjustment. So I got the question, I'll answer this question, Matt, do you still believe in putting warehouse labor in cost of goods sold? Right now in this current model, no, I would not. It is technically a direct cost, but it's overhead. Now, personally, I would do it, but I won't necessarily recommend that for everyone. So that's a very waffly answer, and I apologize for that. The answer I want to say is, why the heck do you still have warehouse labor on full-time staff? Your warehouse labor should be on demand, which is a whole nother conversation. So if it's on demand, it corresponds to your income, and you're not spending it unless you actually have income to offset it. And it follows into that non-specific cost of goods sold labor that is diluted by all of the gross profit from all of the current jobs. If I have zero income and I still have significant cost of goods sold, like warehouse labor, in my opinion, I'm not managing the company as efficiently as I could be. But that is an entire another webinar and probably a lot of therapy as well. Thanks for the question, though. So what is the P&L going to tell us? What are my takeaways from this? You are going to learn very quickly as you monitor it this way that your revenue and overhead grow at different paces. You can double your income without changing your overhead expense at all. And that's exactly what we want, because that is the definition of scalability, right? And you also find that your ability to deliver a predictable job cost is tied to your overall capacity to manage jobs. So if you run out of project management, I guarantee your job cost is going to shoot up, right? And your numbers aren't going to be doing predictable things, which causes us concern. Therefore, we will take action. Either I need to say no to jobs, or I need to add some more internal capacity in project management so that I can get more throughput. So there'll be a point in time where your overhead will no longer be able to support revenue, but it can support a lot more revenue than it has in the past. So to increase revenue past a certain point, overhead expense will need to increase eventually. So you add project management, then later you'll add sales, planning first, then we'll add some more acquisition. And if actual job cost, if your actual job cost starts trending higher than the estimated job cost, then you've exceeded your capacity, or your estimating is off. Assume it's a bit of both, in which case I need to go back and look at my capacity. So now that P&L, I'm excited to open up that P&L every month and see how well we are doing. Question about why would you not put sales commission and cost of goods sold? Because it has nothing, it is not a cost of goods sold. That's the simple answer on that. It is a cost of sales. It's part of what it takes to acquire. It's like, do I put a share of the salesman's salary in cost of goods sold? No, it's not a cost of goods sold. It is a cost of sales. It's below the line expense. Even in GAAP accounting, there's no version of GAAP accounting where a sales commission would go into cost of goods sold. But keep them coming. Keep them coming. All right, balance sheet. Okay, snooze time. Balance sheets are boring. All right, look at your balance sheet. Make your bookkeeper and your accountant. When you close out the month, I want you to print all three of your financial statements out, and I want you to look at them. In the balance sheet, I'm looking for cash on hand, which is the balance. It's the real cash. It's the stuff that's in the account that says your cash balance is. It's money that is ready to be used to pay bills, pay salaries, whatever. You need to know what the healthy number for you is on any given month for the month forward. So you always need cash on hand. Don't spend it because it's there, or don't pay bills because you have cash on hand. Keep your cash on hand as close to a month's worth of cash use as possible. But there's also quick cash, and quick cash is easy to convert. That's going to be your short-term accounts receivables that are going to pay on time. Complicated cash are clients that drag their feet 90 days, money you've got tied up in money market accounts, things like that, where it's going to take you some time to unwind that cash. And keep track of those three numbers, because that is your cash runway, right? That's what's going to keep you alive. And if you run out of income, if we have a hard stop like we did in March of 2020, that's the number that's going to sustain me. And that's going to pay for my overhead because I don't have any gross profit. So look at that number and keep track of that number, because that is your safety net. And try and keep money out of complicated cash. If you're in a dangerous position, we want to move it out. But if you're in a secure position and your cash on hand and your quick cash are healthy, in other words, will carry you for at least the next month, then you can leave some of that money, complicated cash, and pick up that extra 0.025% interest. Operating inventory, you have a carrying cost for your inventory. If you're a formerly rental-based company, you still have a huge, asset with a couple of commas in it on your balance sheet. Instead of looking at the ROI of, what's the gross profit that inventory generated, what I'm looking at is what's the carrying cost to keep it. And if I can reduce my carrying cost by getting rid of inventory, that's something that I want to look at, because that reduces my overhead. So if 75% of your real estate footprint is to house your operating inventory, but your operating inventory is not a huge part of your income anymore, then you've got 75% of your real estate that might need to be rethought. So keep an idea of what it costs to own that equipment and keep that stuff there, including personnel and repairs and things like that. Because at some point in time, you may want to make a decision based on that. Operating debt and line of credit, these serves operating profit. So if you've got a running line of credit, again, that's going to take away from your cash on hand or your quick cash, because technically you've got to unbalance that. You don't have as much liquidity as you thought you did. You should be, if you're operating generally on an agency model, working your streaming and hybrid events, basically the post-pivot business model, you should actually have a lot of cash on hand, and most of you shouldn't be hitting your line of credit very hard right now, based on what I've been seeing. But if you are, then that's something to tell. When we go up on that, then I want to look at that a little bit more carefully. So that's going to trigger me to have a heart-to-heart with my financial people. Yes, meaning we sell inventory and spent $50,000 to move to a new, smaller building. Yeah, sure. Yeah, that's a number of my clients have done that. They've liquidated their inventory to reduce their warehouse expense. It's handy if you can do it at the end of a lease, or you own the building and you can rent it probably to somebody who pays more for it than you do. Yeah, we've seen that quite a bit lately. Statement of cash flows. That's the other statement that comes in your financial package: P&L, balance sheet, statement of cash flows. Why am I looking at that? One, it's a check and balance. There are certain things that only appear in the statement of cash flows, such as non-operating cash out, right? So if I make loan payments, it doesn't show up on my P&L. It only shows up in the statement of cash flows, and then it reduces the balance on my balance sheet. So I want to see what's going on and what is changing in statement of cash flows. And when you're new to this, you're going to have to get your bookkeeper, your accountant, controller to kind of walk you through where the cash is going in and out. But what I want you to learn is how much cash was generated by the jobs that you did, the income that you made, that you conducted, how much cash was generated by that. What's the operating cash in and out? And that should match the P&L. So your operating net profit should be equivalent to the cash that's coming into your statement of cash flows. And then you've got non-operating cash in and out, and that also appears on your statement of cash flows. So that below the line stuff, you want to see where it fits in on there. And what this is going to do is affect your timing. You're going to look at these things and say, hey, if you had a bad month, I want to preserve some cash. I want to keep my cash balances up. Do I have vendors I can put off for another 2 weeks? That sort of thing. So that I can avoid hitting my line of credit. Or do I need to hit my line of credit so that I can get a lot of other things done and increase my buying power by paying cash for something instead of taking terms? So all of those answers are hiding in these 3 financial statements, but you have to spend some time in each of them to understand what they mean and where they go. And then the last of the 6 things I want to talk about is exit strategies. If you've ever tried to sell your company or had somebody try and buy your company, because it's very rarely do the two happen at the same time, you know that you had to recast your financial statements substantially in order to figure out what your business was actually worth. And anybody who's done this knows that they make pro forma P&L statements, and they have an EBITDA and adjusted EBITDA, yada, 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 yada. If you start maintaining your P&L in the model that I suggested, where the non-operating income and expenses are way below the line, below the line, then you'll find that by removing that, you get the operating value of the business, which is what you're going to be valued on from the outside. Now, the person buying you has other numbers that affects your value to them, but the most important is how much cash can this business generate for me, and how will I be able to use that cash and leverage that cash into my future returns. And the non-operating things are generally unique to the current owner, which the buyer doesn't care about. So if you can say, hey, we had a very profitable 2020, and it's all because you had PPP loans, well, the buyer doesn't care. They want to see how you worked without subsidies. So they're going to remove all of those subsidies. So this makes it much easier to see what it is that you're talking about. And the less time you spend talking about unworthy transactions, the more time you have to run your company profitably. And that also means is that now we can focus on where the real value of your exit strategy is, and that is in future revenue. So if you can show through your job costing system and your P&L how accurate you are at converting income into gross profit on a consistent basis, then that book of future business you have is suddenly much more valuable. If we look at companies before the pandemic, then in the before times, we will have to go back and look at 5 years of financials and find out that some years their revenue shot up and their profit went down. And it's very difficult to figure out where the value is in the organization when there's not a lot of direct correlation between income, expense, and profit. But in the model that we're at now, and because we have an economic system now that favors doing business this way, it's much easier to say, yes, if I hire another salesperson and another 50% of a project manager, and I invest in this market segment, and I add $1 million worth of business, this is the ROI. So many of my clients right now, we are adding salespeople and project managers stair step without having to add any other overhead. And it corresponds to an increase of revenue. So this is more revenue we can get. This is more revenue we can manage and distribute among the current sales team that allows all of them to take on new customers. A lot of different ways to spin it. Much easier to look at your business this way. Another question here. I said, I don't pay myself a full salary because we don't have the money to do that right now. Okay, it's not a question, that's a statement, but the question is, how do I record this? Well, look, separate how you think about your profit and loss statement and cash, right? Remember what I was talking about earlier? You want to charge that profit and loss statement for the salary you should be paying yourself, because that tells your management team how successful they are at running a company that is paying all of its bills. If you don't pay the bills, in other words, you don't pay yourself, that's a below the line adjustment, okay? And that's really the owner's choice. That's not a reflection on how well management is running the company. So again, that 2020 example where, yeah, we did okay, but only because of the government subsidies, okay? We didn't do okay because management ran the company well. We did okay because we had subsidy money come in. Now, that doesn't mean the management didn't do a good job. My point is, many of you did not reduce your overhead at the rate that was appropriate for the change in income you saw in 2020. And you hoped that the subsidies would carry you through to the side where all of that income came back and you could once again cash flow. So that was not the right choice, I feel, for some folks, though I know many people felt strongly that that's what they needed to do. All right, so my conclusion on all this, look, I'm all about scalability. A truly scalable business will increase its net profit as revenue grows. So your net profit as a percentage of revenue should grow with income. They don't move in lockstep, because that implies that your overhead increases with income, and it doesn't have to. If you're scalable, you can do a $5 million company can probably do $10 million worth of business in our industry with the same overhead, maybe with a 5% change, right? Management needs to account for profitability by actively balancing resource levels, pricing, and revenue generation, right? Just because you can win business doesn't mean that you want to. It forces you into a cost basis that you're not comfortable with, or is an unworthy risk. If it forces you into taking on overhead that you don't think is sustainable. So one-off income, oh my God, we won a $2 million show. My $2 million company just became a $4 million company. That's a terrifying notion right now. Unless you're set up, your overhead will scale from $2 to $4 million very easily. Non-operating income and expenses, again, need to be clearly separated. This supports your exit strategy. It helps management better see the results of their work, separate from the choices that the owner might make to manage their taxes and their portfolio. So I'd love to have some more questions. Please get them posted here. We've got, I'm doing remarkably well on time for me on this, and I'll get to those in just a second. So again, owners, if you're in a position to take a next step, if these are things that you want to apply or understand how they apply to your business, let's at least have that conversation. Talk about your exit strategy and your long-term goals, because at the end of the day, that's what really matters, and see how you can move forward, or how we can move forward together. So, oh yeah, this book, still a good book. It hasn't even been out for a year, but I'm still getting great feedback on it, and it is still very, very applicable for the things that I'm talking about, because you do need to grow your business, and money spent on marketing is less expensive than money spent on sales. So if I can get my marketing to drive the right customer in, then my salespeople's time is going to be used more efficiently, rather than dealing with people, tire kickers or clients that we don't want to work with. Next month, yeehaw, proposals that work every time. All right, how to present your offer in the new normal, or what we're selling something different, our buyer is different. So once again, what have we learned in the past 23 months about proposals that work in this new environment where we're selling a lot of services, and the transactional portion of what we're doing is surprisingly unimportant. So how to present your offer in the new normal, next February 16th. All right, so back to the questions. I'm going to stop the share, because who needs to look at that, right? And let's see what other questions we have going on here. Okay. Tom, it looks like we make a lot of money on virtual, but I feel like my inventory has to be working. You're not alone. If we don't do shows, we won't stay alive. It's all about loading trucks and getting them on down the road. Okay. The huge gross profit percentage of virtual events is a little bit misleading. It's a little bit of misrepresentation, because most of us look at a virtual event and say, hey, it's $10,000. The studio's here, the team's here, everybody just jumps on headset, we do the job, and we made $9,000, and it looks wildly profitable. However, if we could do that $50,000 show at 50% gross profit, then we make $25,000. And why wouldn't we want to do that? Well, the fact is, that virtual event is actually using a lot of assets, and it's real gross profit, or it's true job cost if you actually fully loaded the burden of replacement costs for everything. It is high. It's probably higher than a live event by far. But it's not quite as high. So your inventory has to be working, because it will help you generate gross profit on jobs that need inventory. But the fact is, if you could do $10,000 virtual events, or two $50,000 live events, which, as you have found out this month, are still really risky and can get canceled, or can reschedule where they have overlapping dates and all of a sudden they don't look nearly as profitable. If you fully burdened those jobs with replacement costs, you don't really have 50% gross profit on live events. You have closer to 25%, maybe 30% gross profit. So before we get too wound up about the inventory that is not working and the emotional toll that takes, because we are live event people, and we think that means people in a ballroom with us, and that's fine. Go back and cost your jobs correctly with replacement costs. Ignore what is available to save cash. Okay. Look at costing your jobs properly, and you'll feel differently, I think, about those jobs. And I think you'll welcome the nice mix of streaming events and hybrid events and full service in-person events, and the combination of all three, ideally. Next question. Can you expand a little bit on your comments related to not focusing on the ROI of gear and instead evaluate the carrying costs? What would be the best operational approach to review and manage this? I mean, I'll try and expand a little bit more. If you have an inventory, you got $1 million worth of equipment inventory as bought. Maybe you have some debt service because you're paying on some of it through a lease or whatever, or some pre-pandemic debt. There's some carrying cost. Depreciation is a carrying cost. If there's still depreciable assets there, it does reduce your taxable income, which is great. But then the biggest concern is the floor space and the people, service, repair, supplies, parts, blah, blah, blah. But the floor space and the people that it takes to do that. For me, to run a warehouse with $1 million of equipment, now I need somebody to prep shows and de-prep shows, and I've got rental management software, and I've got barcodes, and I've got to shoot things, and I've got to load trucks, and I've got all these hours that are involved every time that equipment works. If it doesn't work, I still have costs of just that floor space. So look at those numbers, and it gives you a better understanding of what these are costs of goods sold, what your actual cost of goods sold is. So to Matt's question earlier, where do I put my warehouse crew? Well, if you're going to follow the model where you're trying to get an ROI on assets, your warehouse crew is a cost of goods sold. And if you're paying them when the equipment is not working, you're going to lower your overall gross profit. So they become part of that carrying cost, because you're going to find busy work for them to do. Oh, we don't have a show to prep today. Okay, well, let's work on the project. Well, that's how we justified having people before the pandemic. But the fact is, all of your work should be on demand, and your warehouse should always be in a zero state. So when that crew finishes receiving a show in, everything's back in place and there should be nothing left to do. I can send everybody home until I come back in again. Anything above that, again, is carrying costs. So figure out how you can zero state your business, even if it's just on paper, and figure out when do you actually need people versus when are you actually paying for people. But the big thing for many of you is going to be the real estate, the insurance, all of those costs that you wouldn't have if you didn't own quite so much equipment. Let's see, another question here. Oop, can't close the question box and get questions, can I? Q&A box. So what about roles of split between delivery and planning or selling? The fact is you have roles that, so selling and planning is below the line. Okay, that's your cost of sales. Delivery is, I went out on job site in a billable position. If you have some roles, project manager is the most likely one, that work between the two. On my P&L, I might arbitrarily say 50% of project management time goes into cost of sales, 50% of project management time goes into cost of goods sold. You should be tracking hours. Okay. All of your people, salaried people, should be tracking hours. You need to know what their hours are being spent on. If you are tracking hours, then you can actually cost those hours above or below the line, depending on what their work distribution was that month. That will give you a more accurate picture. However, I will argue that when project managers are busy doing shows, all we're doing is hurting our sales effort, because if they are part of the sales effort, part of estimating, part of selling, part of making sure we do the right thing, that job is not getting done well. So we're giving something up. So we're subsidizing the show, but we're taking by taking something away from the sales process. So in my ideal world, my project managers who do shows are only on demand for shows, which means they're always a direct expense. And my project managers that support the sales process are always part of sales. And I generally would only need one person for a sales team to do that. A great comment here and question here, Tom. How should we expect to keep a capable warehouse staff if we send them to part-time? They will find other gigs. Guys, you have to pay them more. You have to make the part-time gig more valuable to them. You can't pay them the same $15 an hour. They probably should be making 25, 28 bucks an hour. And yes, they will find other gigs, but they'll probably want to take your gig first. So we are in a different economic model. So if you're keeping warehouse staff so that you can keep them at a lower rate, but what do you do every time we have an Omicron and you have no income for 6 or 8 weeks? Are you going to lay everybody off again? It's the same problem. So use the gig economy to your advantage, right? There's a replacement cost for a capable warehouse worker on a short-term basis. That's what it costs to have a capable warehouse worker. I'm not saying it's easy. I'm not saying that, just by saying so you can do this, but this is the problem you have to solve, because it does not make sense to keep warehouse people year round when you do not have year round work for them. Let's be honest. But it's hard. I understand. This is a very different way of looking at things. We have our warehouse crew. Next question. We have our warehouse crew, load in, load out crew, creative team, and program managers account for time per job. Good. To reduce the hit on overhead. The bank doesn't like to see large overhead to open the door. Do you think this is the right way of reducing overhead? If you've got bank covenants on overhead, the bank's just telling you the same thing I'm telling you. Overhead is bad. Okay. They may be telling you for a different reason, but that is a way of doing it. The problem with that is that if you don't have work for those people, warehouse crew, load in, load out crew, creative team, program managers, if you have people that you're paying and you have to move them down below the line because there's no job to cost them again, now I've got overhead that's moving up and down, and now my P&L is no longer actionable because it's not giving me good data. And I'll give you the perfect example of this, because I still see it in the systems integration world, where they take their technical install crews, which they're very loath to outsource. And if they are not busy installing a job, those hours get costed below the line as overhead. Well, that makes their cost of goods sold look incredibly consistent, because cost of goods sold is not paying for any of the unused cost of goods sold assets. Overhead is absorbing them. So they get this beautiful gross profit, consistent gross profit line of 27% or whatever number they're trying to hit, but their overhead line is all over the map. And if they have a bad month or 6 months, then they think they're doing great because their cost of goods sold numbers are so good. And in fact, they're bleeding out through their overhead line. So yes, yeah. If you say, I don't think warehouse workers are gig economy people, that's fine. I mean, I understand your position. I'm just telling you what my recommendation is. Let's see. What do you feel we will need to spend for full-time 50% inside person for writing rental? I can't tell you what you're going to need to spend for a specific position and doing some yeah, no, I can't give you a price range for somebody in your marketplace based on that. I do recommend the interwebs for finding out what positions are worth. If you can't write the job description to match what you find on Indeed or any other kind of staffing service that will tell you what the pay ranges are by, then you're creating a job that's not fillable. So do a little bit of the research to find out how that actually works in your marketplace. When you over-engineer a job description, I typically find you're not solving the fundamental problem if you're getting very specific about all of those things. And I got last question here. Okay. What are some of your favorite metrics KPIs for an operations manager to evaluate the efficiency of a warehouse crew prepping or de-prepping shows? I like that question. That's a good question. It would really depend on the processes that you're using in your warehouse. For me, obviously it's a simple time calculation. If you are de-prepping properly, and operations starts at de-prep, by the way, it doesn't end at de-prep. De-prep is the first step of operations, because it's how we get our assets back into their zero state, and then we go home. So if you're de-prepping a show, okay, at the end of that, you go home because everything's back into zero state. So how long does it take to de-prep a show? Some are going to take more than others. If you're de-prepping a show takes a long time, I'm going to look at how your equipment is packaged, how it's stored, what's the availability of replacement parts in your QC process. Do you have enough cables to restock a package without having to go search for it? That sort of thing. And it's not really the crew that I'm measuring the efficiency of the design of the process in the warehouse and the packaging and all of that. So it does really come down to, as I circle back to a time calculation, is how much time is it actually taking? And it's easier to calculate if at the end of that time you go home. Not you do some of this work and then we go over here and we do this for a little bit and then we come back to it. You have to treat it as a task. De-prepping, when a truck hits the dock, everything else stops. We unload that truck, we check it in, we de-prep it, we QC it, we put it back on the shelf ready to go. We go back to whatever it is that we were doing. And that makes it a very measurable, actionable process. Thank you for that. That's a good question. Good exercise. Folks, you know how to find me. Feel free to shoot me an email with more questions. Schedule some time with me if you'd like to talk about how we can help you in your business. And we will see you here next month. Thanks for coming. Bye.